Two neighbors, same street, same zip code. One of them gets a $23,000 tax refund this year. The other owes $4,800. Same income. Both earn right around $180,000. Both pay their taxes on time. Neither one is doing anything illegal. So what happened? Look, that question kept me up for a while when I first started digging into this, because the answer isn't complicated once you see it, but most people never see it. Not because they're not smart enough, because nobody ever showed them where to look. Here's the thing about the tax code. It's long, it's dense, and honestly, it's written with certain households in mind. Not in a conspiracy way, just in a very practical, structural way. There are decisions built into that code that reward specific behaviors, specific account types, specific timing. And the households using those decisions tend to have one thing in common. They learned the rules before they started playing. The neighbor who owes $4,800, he's not bad with money. Actually, he's pretty disciplined. Saves some, invests a little, doesn't overspend, but he's playing the tax game the way most people play it, reactively. Money comes in, gets taxed, he works with whatever's left. The neighbor with the refund flipped that sequence entirely. That single difference, the sequence, is what this whole conversation is about. And I want to be honest with you up front. This isn't about exotic strategies. It's not about offshore accounts or anything that requires a team of lawyers. The things I'm going to walk through today are available to regular households. People earning $60,000, people earning $120,000, people earning $200,000. The gap isn't about income level, it's about awareness. Okay, so here's the reframe that changes everything. Most people think about taxes as a percentage of what they earn. You earn $100,000, the government takes 22%, you keep the rest. That's how most people understand it. But that's not actually how the tax code works. The tax code doesn't tax what you earn, it taxes what it can see. Pause on that for a second. What it can see. There are entire categories of financial activity that the tax code either doesn't see at all, sees later, or sees at a reduced rate. In high-income households, the ones with dramatically lower tax bills have structured their financial lives around those categories. They didn't earn less, they didn't hide anything. They just moved activity into parts of the code that the government treats differently. Here's a simple way to think about it. Imagine your income is water flowing into a bucket. The government measures what's in the bucket and taxes it. Most people let all the water flow straight in, but the tax code has legal channels built into it, channels that redirect some of that water before it ever hits the bucket. Retirement accounts, business structures, health accounts, investment timing. Each channel is a legal redirection, and most people walk right past those channels every single year, not because they're unavailable, because they're invisible if nobody points them out. That's the paradigm shift right there. Stop thinking about taxes as a fixed percentage of income. Start thinking about them as a negotiation between your financial behavior and what the code chooses to measure. The households winning that negotiation aren't smarter than you. They just know which game they're actually playing. My name is Ricky, and I've spent years studying why two households with identical incomes can end up in completely different financial positions just based on how they interact with the tax code. If you're someone who earns decent money and still feels like you're giving away more than you should every April, hit that subscribe button. Give this a thumbs up if something just clicked, because we're just getting started. All right, let's get into the actual decisions, the ones that create that $23,000 gap. 5 of them. And for each one, I want to show you the math and the psychology, because both mattered equally here. Here's the first decision, and honestly, this one frustrates me the most when people skip it, because it's the most available and the most ignored. It's called pre-tax contribution, and the concept is almost embarrassingly simple. Before your income gets reported to the IRS, you redirect a portion of it into accounts the tax code doesn't count as taxable income. Your 401k, a traditional IRA, an HSA if you have access to one. Let's look at what this actually does to the numbers. Say you earn $120,000 a year. You contribute the maximum to your 401k, which is right around $23,000. The IRS doesn't see $120,000. They see $97,000. You just legally erased $23,000 of taxable income before the government even opened their eyes.
At a 22% bracket, that's about $5,060 you don't pay. Gone, legally, before the money ever touched your checking account. Now here's the psychology that makes people skip this. The contribution feels like a loss. You're watching money leave your paycheck every 2 weeks. It feels like sacrifice. So people contribute just enough to get the employer match and stop there. But that framing is completely backwards. You're not losing that money. You're moving it to a place the IRS can't reach yet. It still belongs to you. It's still growing. You're choosing when the government gets to see it. That's a very different thing. The household with the $42,000 tax bill contributing maybe 3 or 4%, getting the match, calling it a day. The household with the $19,000 maxing every pre-tax account available, every single year without exception. That one habit alone over a 30-year career represents hundreds of thousands of dollars in taxes never paid, not investment returns, tax savings, money that never left. Before I get to this one, I want to say something. This is the rule I wish someone had explained to me 10 years earlier, because most people with access to this account are using it in the completely wrong way. I'm talking about the health savings account, the HSA. Most people treat it like a debit card. Something comes up, you swipe the HSA, done. Makes sense on the surface. But here's what high-income households actually do with it. The HSA is the only account in the entire tax code that is triple tax advantaged. Contributions go in pre-tax, the money grows tax-free inside the account, and withdrawals for qualified medical expenses come out tax-free. No other account does all three. Not your 401k, not your Roth, nothing else. Now, here's the move most people completely miss. If you can afford to pay your current medical expenses out of pocket, just do that. Pay them out of pocket. Don't touch the HSA. Let the HSA sit, invest it inside the account in index funds, and save every single medical receipt. Because here's what the IRS doesn't advertise loudly enough. There is no time limit on HSA reimbursements. You can pay a medical bill in 2024 out of pocket, save the receipt, and reimburse yourself from the HSA in 2032 or 2038 or whenever you need a large chunk of tax-free cash. You've just created a personal tax-free reserve funded with pre-tax dollars, growing tax-free, withdrawn tax-free, with a paper trail of real receipts backing every single dollar. Honestly, when I first learned this, I was a little annoyed that nobody had mentioned it before. Like, this is real, and it's just sitting there. The household with the $19,000 tax bill treats the HSA like an investment account with a receipt backup system. The household with the $42,000 bill treats it like a debit card. That single shift is worth $15,000 to $25,000 in tax-free growth over a decade for doing almost nothing differently except saving receipts and not spending the account.
This next one surprises people when they hear it, because we all kind of assume income is income. It isn't. The IRS taxes different types of income at completely different rates. And once you see this clearly, it changes how you think about every investment decision you make going forward. Here's the core distinction. If you work a job and earn $80,000, that's ordinary income, taxed at your marginal rate. Could be 22%, could be 24%, possibly higher. But if you own an investment, hold it for more than 1 year, and then sell it, that profit is a long-term capital gain, and the tax rate on that is either 0, 15, or 20%, depending on your total income. 0%. For households earning under roughly $94,000 jointly, long-term capital gains can be completely tax-free. Think about what that means practically. You could earn $40,000 from investments in a given year and own nothing on it if you planned your other income carefully enough. High-income households structure their assets to produce as much long-term capital gain income as possible and as little ordinary income as possible, especially in years where they have more control over the numbers. Now, I want to be straightforward here. Most people can't choose to be paid entirely in capital gains. That's not the point. The point is that when you do have investments, when you hold them and when you sell them matters enormously. Selling after 1 year instead of 11 months can change your tax rate by 10 percentage points on the same dollar. The average household never thinks about what type of income they're generating. The strategic household thinks about it every year without exception. Okay, before I get into this one, I want to ask you something directly. Do you have any income that isn't from a regular W-2 job? Freelance, consulting, side business, rental property, anything? If yes, keep listening because this rule is specifically for you and it might be the most immediately actionable thing in this entire conversation. And even if you don't have that yet, understanding this changes how you think about side income the moment it shows up. So stay with me. Here's the exciting version of this first. The tax code treats business owners fundamentally differently than it treats employees. A self-employed person earning $150,000 in revenue can deduct legitimate business expenses before their income is even calculated. Home office, vehicle use, equipment, software, professional development, health insurance premiums in many cases. After real deductions, that $150,000 in revenue might show up to the IRS as $108,000 in taxable income. Same economic activity, completely different taxable number. And then there's the entity structure layer on top of that. An S corporation allows business owners to split income between a salary and distributions. Salary gets hit with payroll taxes. Distributions don't. At certain income levels, that difference saves thousands of dollars every single year. For a W-2 employee earning $150,000, there's really not much to negotiate. You earn it, you report it, you pay it. For someone with legitimate self-employment income, the conversation is completely different. You do need a good accountant to structure this correctly. One sentence, I mean it. But that conversation, that single meeting, could be the highest return hour you spend this year. This last one is about timing, and it might be the most elegant strategy in the entire tax code. Here's the situation it applies to. Some years your income is lower than normal. You changed jobs, you took time off, you had a business loss, you retired early and haven't started drawing Social Security yet. In those lower income years, your tax bracket drops. Maybe you're in the 12% bracket instead of your usual 22. Most people experience those years and just move on. Lower income, lower taxes, fine. Strategic households use those years intentionally. They convert money from a traditional IRA, which they'll eventually owe taxes on when they withdraw it, into a Roth IRA, which grows completely tax-free forever. And they do that conversion in the lower income year, paying 12% now instead of 24 or 24% later in retirement. The difference between 12% now and 24% later on the same dollar is not small. On $50,000 converted, that's $6,000 saved in a single decision. On $100,000, it's $12,000. In 1 year, one conversation with your accountant. And Roth accounts have another benefit that compounds this further. No required minimum distributions. If you don't need the money, it just keeps growing, tax-free, for the rest of your life. Strategic households map out their income, decade by decade. They identify the low-income years in advance, and they treat those years as opportunities rather than just quiet years. Most people don't even know this window exists. Okay, 5 decisions: pre-tax contributions, HSA investing, income type awareness, business structure, Roth conversion windows. Each one saves real money on its own. But here's what most finance content never shows you, and this is the part that separates the households that save $5,000 a year in taxes from the households that save $23,000. These 5 decisions don't add together, they cascade. Let me walk you through exactly what that looks like with real numbers. Take a household earning $180,000, 2 incomes. Before any planning, their taxable income is roughly $155,000 after the standard deduction. They're sitting solidly in the 22% bracket. Their long-term capital gains rate is 15%. Now they make one decision. They max both 401k contributions. That's $46,000 combined removed from taxable income. Now the IRS sees $109,000. That one move just dropped them from the 22% bracket into the 12% bracket. Here's where the cascade starts. At $109,000 in taxable income, their long-term capital gains rate just dropped from 15% to 0. That investment portfolio they've been building, any gains they realize this year are now completely tax-free. Rule 1 just unlocked Rule 3 automatically. Now, because their effective tax rate dropped significantly, they have more flexibility in their cash flow. They can afford to pay medical expenses out of pocket this year without touching the HSA. So the HSA keeps growing tax-free. Rule 2 compounds silently in the background. And because they dropped into a lower bracket this year, maybe one spouse took some time off or they had a slow quarter in their side business, their accountant flags it. This is a Roth conversion window. They convert $40,000 from a traditional IRA at 12%. Rule 5 activates because Rule 1 made it possible. One decision, 4 consequences. None of them required extra income. None of them required a new strategy. They just understood that the rules connect to each other. That is why the gap between two identical households compounds over time. It's not that one made one smart move every year. It's that each smart move quietly opened the door to the next one. And after 10 years, those doors have been opening and compounding, and the distance between the two households isn't $23,000 anymore. It's an entirely different financial life. Remember those two neighbors from the beginning? Same street, same income. One owes $4,800, one gets $23,000 back. By now, you can see exactly what happened. One of them is contributing the minimum to retirement, paying medical bills straight from the HSA without letting it grow, earning ordinary income with no attention to type or timing, no business structure conversation, no conversion strategy, no intentional planning. The other made 5 quiet decisions throughout the year, none of them dramatic, none of them complicated, none of them requiring a finance degree or a Wall Street connection. They just understood that the tax code isn't a fixed wall, it's a system with doors in it, and they learned where the doors were. Here's the number I want you to leave you with. The neighbor paying an extra $23,000 every year. Over a 30-year career, that's $690,000 in additional taxes paid. Money that left, gone. But if that money had been invested instead at a modest 7% annual return, we're talking about over $2.5 million. Not because of some exotic investment strategy, not because of luck, just because one household understood the sequence and one didn't. That's not a rounding error. That's a completely different retirement, a completely different level of options, a completely different life. The tax code rewards specific behaviors: saving, long-term investing, business formation, healthcare funding. Those incentives were deliberately written in, and they are available to you right now at whatever income level you're at. The question was never whether the doors exist. The question is whether you're going to walk through them. Pay what you legally owe, not a dollar more, and stop leaving money on the table because nobody sat you down and showed you where to look. That's what today was about. If this opens something up for you, give it a thumbs up and drop in the comments which of the 5 rules you want me to go deeper on. I'll build the next video around whichever one gets the most response. See you then.